Look, I need you to understand something right now. While everyone's been distracted by the headlines, by the noise, by whatever crisis the media is pushing this week, something extraordinary has been building in the silver market. And I'm not talking about some distant possibility. I'm talking about a move that's already in motion. Silver just hit $64 per ounce. Let me say that again because I want it to sink in. $64. We're not theorizing about $50 anymore. We blew past it. And here's what nobody's telling you. This isn't the top. This is just the beginning of something much, much bigger. You see, there's this moment in every major market move where the smart money has already positioned themselves, where the fundamentals have already shifted, but the general public hasn't caught on yet. That window, it's closing, fast. And what I'm about to show you is why the countdown to even higher prices has already begun, why the supply-demand dynamics have reached a breaking point, and why some of the world's most sophisticated investors are treating silver like it's the last lifeboat on the Titanic. But first, let me take you back to understand how we got here. Because this story doesn't start with today's price. It starts with a structural problem that's been building for years, hidden in plain sight. For the past 5 consecutive years, the silver market has been in a supply deficit. Think about what that means. 5 years. That's not a blip. That's not a temporary imbalance. That's a fundamental shift in the market structure. Every single year, the world has consumed more silver than it's produced. And unlike gold, which mostly just sits in vaults, silver gets used up. It goes into solar panels, into electronics, into medical devices, into batteries. It gets consumed and it doesn't come back. The Silver Institute's data shows something remarkable. Industrial demand for silver has been climbing relentlessly, driven by the green energy transition. Every solar panel requires about 20 grams of silver. Every electric vehicle uses up to 1 kilogram. 5G infrastructure, medical applications, water purification systems. The list goes on. And here's the kicker. There's no substitute that works as well. Silver is the most conductive metal on Earth. It's the most reflective. It has unique antibacterial properties. You can't just swap it out for something cheaper. Meanwhile, mine production has been essentially flat. The easy silver has already been found. The high-grade deposits have been depleted. What's left requires more energy, more capital, more time to extract. And with energy costs where they are, with environmental regulations tightening, with permitting processes taking years, new supply isn't coming online fast enough to meet demand. So what happens when you have 5 consecutive years of deficits? The above-ground stockpiles start to drain. The inventories that took decades to build start disappearing. And at some point, you hit a wall. We're hitting that wall right now. Let me paint you a picture of what's happening in the physical market. The COMEX, the major exchange where silver futures trade, has seen its registered silver inventories drop dramatically. We're talking about the silver that's actually available for delivery, not just sitting in warehouses. It's been declining for months. At the same time, premiums on physical silver coins and bars have been elevated. When you go to buy actual metal, you're paying significantly more than the spot price. That spread? That's telling you something. It's telling you there's stress in the physical market. And then there's what the big players are doing. Central banks, which traditionally focused on gold, have been quietly accumulating silver. Not in the same quantities as gold, but the shift is notable. Sovereign wealth funds are taking positions. Family offices are allocating. These aren't retail investors chasing momentum. These are institutions with billion-dollar portfolios and teams of analysts making calculated moves based on long-term fundamentals. Keith Neumeyer from First Majestic Silver, one of the largest primary silver producers in the world, has gone on record saying he sees silver reaching $100 per ounce. Now, you might think that's just a mining executive talking his book, but listen to his reasoning. He's looking at the same supply-demand fundamentals I just described. He's seeing the same inventory drawdowns. He's watching the same industrial demand growth. And he's running a company that actually produces the metal, so he has visibility into the cost structure, into how difficult it is to bring new supply online. But here's where it gets really interesting. Let's talk about the gold to silver ratio. Throughout history, this ratio has been a powerful indicator of relative value. Right now, even with silver at $64, gold is trading at over $2,700 per ounce. That puts the ratio around 42 to 1. Historically, that ratio has averaged closer to 60 or 70 to 1 in modern times, but there have been periods where it's compressed much tighter. In 2011, during the last major precious metals bull run, It got down to 32 to 1. In 1980, it briefly touched 17 to 1. What does this mean? It means that even at current prices, silver could have significant room to run just to catch up to gold's performance. If gold continues higher and silver starts closing that ratio gap, you're looking at prices that would make today's levels look like a bargain. Now, I want to address something important here because it relates to your financial future. If you're sitting on retirement accounts, if you have $100,000 or more in traditional IRAs or 401ks, you need to understand that there are ways to get physical precious metals into those accounts without triggering tax penalties. I've put together a comprehensive guide on how gold IRAs work, how you can diversify your retirement holdings with physical metals, and what the process actually looks like. It's completely free, and you'll find it in the description below. This isn't about abandoning your other investments. It's about understanding all your options for protecting wealth in an environment where currency debasement is accelerating. Worth checking out if that's relevant to your situation. But let's get back to where this price is headed next, because the technical picture is just as compelling as the fundamentals. Silver recently broke through major resistance levels that had held for years. When you look at the charts, you can see clear consolidation patterns that preceded this move. The breakout above 30 was significant. The push through $40 confirmed the trend. And now, trading in the 60s, we're in price discovery mode. There's no recent resistance overhead because we haven't been at these levels in over a decade. Technical analysts are pointing to measured move targets that suggest significantly higher prices. If you take the base of the consolidation pattern and project it upward from the breakout point, you get targets in the $80 to $100 range. Now, technical analysis isn't a crystal ball, but when the technicals align with the fundamentals, when the chart pattern confirms what the supply-demand dynamics are telling you, that's when you pay attention. And here's something that doesn't get talked about enough: the paper silver market versus the physical market. The vast majority of silver trading happens in the futures market, in derivatives, in contracts that never result in physical delivery. It's estimated that the paper market is leveraged anywhere from 100 to 1 to 250 to 1 against actual physical metal. Think about that. For every ounce of real silver, there are potentially 100 to 250 ounces worth of paper claims. This works fine in normal times. But what happens when people start demanding physical delivery? What happens when the industrial users who actually need the metal start competing with investors who want to hold it? What happens when the inventories run low and someone calls the bluff? You get a squeeze. You get a situation where the paper price has to adjust to reflect physical reality. And that adjustment? It doesn't happen gradually. It happens in violent moves that catch everyone off guard. We've seen hints of this already. There have been periods where the futures market showed one price while physical dealers were charging premiums of 20%, 30%, even 40% over spot. That disconnect can't persist indefinitely. Eventually, the paper price has to rise to meet the physical market, or the whole structure breaks down. Let me tell you about what happened in 1980, because there are eerie parallels to today. Silver went from around $6 per ounce in 1979 to $50 in January 1980. That's more than an 8x move in about a year. What drove it? A combination of factors: high inflation, which we have today; currency concerns, which we have today; the Hunt brothers trying to corner the market, which created a supply squeeze; and industrial demand that was growing faster than supply. Now, I'm not saying we're going to see an exact repeat. The market structure is different. The regulatory environment is different. But the fundamental drivers are remarkably similar. We have inflation running hot despite what the official numbers say. We have currency debasement on a scale that would have been unimaginable in 1980. We have industrial demand that's not just growing, it's accelerating because of the energy transition. And we have a supply situation that's arguably tighter than it was back then. Here's what's different this time, though, and why it might actually be more bullish for silver. In 1980, the move was largely driven by investment demand and speculation. The Hunt brothers were accumulating massive positions. When they were forced to liquidate, the price collapsed. But today, the demand is structural. It's coming from industries that need silver to function. Solar panel manufacturers can't just decide to stop using silver if the price goes up. EV makers can't eliminate it from their vehicles. The demand is sticky, it's persistent, and it's growing. The International Energy Agency projects that solar capacity will triple by 2030. Every single one of those panels needs silver. The automotive industry is transitioning to electric vehicles at an accelerating pace. Every single one of those vehicles needs significantly more silver than a traditional car. 5G networks are being built out globally. The infrastructure requires silver. This isn't speculative demand that can disappear overnight. This is real physical consumption that's baked into the global economic transition. And then there's the monetary aspect. Central banks around the world have been printing money at unprecedented rates. The Federal Reserve's balance sheet exploded. The European Central Bank, the Bank of Japan, the People's Bank of China, they've all been creating currency at a pace that would have been considered reckless just a generation ago. And what happens when you dramatically increase the supply of currency? The value of that currency relative to real assets declines. Precious metals, which can't be printed, which have intrinsic value, which have been money for thousands of years, become more valuable in currency terms. Silver, in particular, has this unique dual nature. It's both an industrial metal and a monetary metal. It's used in manufacturing, but it's also been used as money throughout history. In fact, the word for money in many languages is the same as the word for silver. This dual demand creates a powerful dynamic. When industrial demand is strong, it supports the price floor. When monetary demand kicks in, it can drive explosive moves higher. We're seeing both right now. Industrial demand is at record levels and climbing, and monetary demand is starting to wake up as people realize that holding cash in a bank account that pays 4% interest while real inflation is running at 8% or 10% is a guaranteed way to lose purchasing power. Let me share something that most people don't know. The silver market is tiny compared to other asset markets. The entire above-ground stockpile of silver, all the silver that's ever been mined and is still in existence, is worth maybe $1.5 trillion at current prices. That sounds like a lot until you compare it to other markets. The global bond market is over $130 trillion. The global stock market is over $100 trillion. The global real estate market is over $300 trillion. Silver is a rounding error. What does this mean? It means that if even a small percentage of capital from these larger markets decides to flow into silver, the impact on price would be enormous. If just 1% of global bond holdings decided to diversify into silver, that would be over $1 trillion trying to flow into a market that's only worth $1.5 trillion total. The price would have to rise dramatically to accommodate that demand. And we're starting to see signs that this capital rotation is beginning. Exchange-traded funds that hold physical silver have seen inflows. The premiums on silver coins from government mints have been elevated, indicating strong retail demand. Institutional investors are starting to add precious metals exposure to their portfolios. The smart money is positioning ahead of what they see coming. But here's what really keeps me up at night. In a good way if you're positioned correctly. The geopolitical situation. We're living through a period of unprecedented tension between major powers. The U.S.-China relationship is strained. Russia has been cut off from the Western financial system. The BRICS nations are actively working to create alternatives to dollar-based trade. Countries are diversifying their reserves away from dollars and into hard assets. What does this have to do with silver? Everything. Because when trust in the global financial system erodes, when countries start questioning whether their dollar reserves are truly safe, when the weaponization of the financial system becomes a tool of foreign policy, everyone starts looking for assets that can't be frozen, can't be sanctioned, can't be devalued by a central bank's printing press. Gold and silver fit that bill perfectly. We've already seen central banks buying gold at record rates. But silver, being more affordable and having that industrial demand component, is increasingly attractive as well. If the trend toward de-dollarization continues, if more countries decide they want to hold real assets instead of paper promises, the demand for precious metals could overwhelm the available supply. And let's talk about the mining industry for a moment, because this is crucial to understanding the supply side. Silver mining is not a high-margin business at current prices. Most silver is actually produced as a byproduct of mining other metals like copper, lead, and zinc. Only about 30% of silver comes from primary silver mines. This means that silver supply is largely dependent on the economics of mining these other metals. If copper prices fall, copper mines shut down, and silver supply drops as a byproduct. If lead and zinc become uneconomical to mine, silver supply drops. The industry doesn't have the flexibility to just ramp up production when silver prices rise. It takes years to develop new mines. It takes massive capital investment, and with ESG concerns, permitting challenges, and community opposition, it's harder than ever to bring new supply online. Meanwhile, the grade of silver ore being mined has been declining. Miners are having to process more rock to get the same amount of metal. This increases costs, increases energy consumption, and makes the whole process less efficient. At some point, if prices don't rise enough to justify the increased costs, mines shut down and supply contracts further. We're approaching a perfect storm scenario. Demand is accelerating from multiple sources. Supply is constrained and can't respond quickly. Inventories are being drawn down. The paper market is leveraged to an extreme degree. Geopolitical tensions are rising. Currency debasement is accelerating. And the price has already broken out to multi-year highs, confirming that something fundamental has changed. Now, I want to be clear about something. I'm not saying silver is going to go straight up from here without any pullbacks. Markets don't work that way. There will be volatility. There will be corrections. There will be moments where it feels like the move is over. But the underlying trend, the structural forces at play, they're not going away. They're intensifying. When silver hit $50 in 2011, it was driven largely by investment demand and concerns about the financial system in the wake of the 2008 crisis. The move was fast, it was emotional, and when it reversed hard. But the fundamentals today are different. The supply deficit is real and persistent. The industrial demand is structural and growing. The monetary environment is even more extreme than it was in 2011, and the geopolitical backdrop is more uncertain. If silver is already trading at $64, and the fundamentals suggest we're in the early stages of a major bull market, where could it go? Some analysts are talking about $100. Some are talking about $150. Keith Neumeyer, as I mentioned, sees $100 as achievable. But here's the thing. In a real supply squeeze, in a scenario where the paper market breaks down and physical demand overwhelms available supply, the price could go to levels that seem absurd right now. Think about what happened with palladium. It went from around $500 per ounce in 2016 to over $3,000 in 2022. Why? Supply deficit driven by automotive demand for catalytic converters. The market was tight, inventories were low, and when demand spiked, there wasn't enough metal to go around. Silver has a similar setup, but with even broader industrial applications and the added monetary demand component. I'm not making a prediction that silver will hit $3,000. But I am saying that in a genuine supply crisis, prices can go to levels that seem impossible beforehand, and the setup in silver right now has all the ingredients for that kind of move. Here's what you need to understand about market psychology. Right now, most people still think of silver as a speculative trade. They think of it as something that goes up and down based on sentiment and momentum. But there's a shift happening. More people are starting to view it as a strategic asset, as something you hold for wealth preservation, as something that has intrinsic value in a world where paper assets are increasingly questionable. When that psychological shift reaches critical mass, when silver transitions in the public consciousness from a trade to a must-have asset, that's when you see the kind of moves that define a generation. We saw it with gold in the 1970s. We saw it with tech stocks in the late 1990s. We saw it with real estate in the mid-2000s, and we might be seeing the early stages of it with silver right now. The countdown to $50 has already happened. We're past it. The question now is, what's the next target? And more importantly, are you positioned for what comes next? Because here's the reality. By the time everyone agrees that silver is going higher, by the time it's on the front page of every financial publication, by the time your neighbor is talking about it at dinner parties, the easy money has already been made. The opportunity is now, while there's still skepticism, while people are still debating whether this move is real, while the mainstream financial media is still focused on stocks and bonds and crypto. The smart money doesn't wait for confirmation. They position ahead of the crowd. And look, I get it. It's uncomfortable to go against the grain. It's uncomfortable to invest in something that most people aren't talking about. But that's exactly when the best opportunities present themselves. When the fundamentals are screaming one thing, but the crowd hasn't caught on yet. That's the edge. That's where wealth is built. The silver market is sending clear signals. The supply deficit is real. The industrial demand is accelerating. The monetary environment is supportive. The geopolitical backdrop is favorable. The technical breakout is confirmed. And the price is already proving that something fundamental has changed. The countdown to $50 is over. The countdown to whatever comes next has begun. And based on everything I'm seeing, based on the structural forces at play, based on the historical precedents and the current market dynamics, this move has a long way to run. The question isn't whether silver is going higher. The question is, how high can it go, and how fast will it get there? Because when supply and demand get this far out of balance, when the physical market starts dictating terms to the paper market, when industrial users start competing with investors for limited supply, prices don't just drift higher. They explode. And we might be on the verge of exactly that kind of explosion. The clock is ticking. The fundamentals are aligned, the breakout is confirmed, and the opportunity is right in front of you. What you do with that information is up to you. But don't say you weren't warned when silver is trading at levels that make today's price look like ancient history.